4. Let's just take a look at an item that we covered last week, just to refresh our memories. And that would be this old thing here. This is a homework problem. We're going to do one of the parts right now. Hello, Rachel. Thanks for joining us. We are a class of 3 people right now, which means either the announcement didn't get out to everybody, everyone's out shoveling, or other things like that. So there we go. All right, turn off the phone. What we are going to do is look over part of the homework now. Let's just do it together. We had a situation where Ritz Corporation acquired 80% of Shaw Corporation common stock for $956,000. So 80%. What you want to do first when you see that $956,000 for 80% is you want to figure out what I'm going to tell you steps that you should do with these problems. That's what I'm going to tell you. Of course, you're supposed to read what the problem's about, but almost you know that you're going to need to understand certain things about the problems. So rather than read what the problem's asking here, which would be the right way to approach it from the standpoint of most efficiently being able to answer the question, we'll just figure out as much as we know from the facts given. We won't need all the facts, but let's just start with what we know and see what it means. The $956,000 was what Ritz Corporation paid for the 80%. So if that's what they paid for 80%, if you do the math and you divide $956,000 by 80%, what you will effectively get is the fair value, the implied fair value for the entire company. Meaning if they had bought 100%, it seems like they would have paid $956,000 divided by 0.8 would have been the amount, and that comes out to $1,195,000. So that's one thing that you now know, and you should really figure that out in your on your worksheets as you work through these kinds of problems, so you know what you're dealing with. So once again, what's the implied value of 100% of the company, and why are we doing this? Because we know that we're going to present 100% of the company on the consolidated financial statement. That we know, that's a given. And so, having said that, we now understand that the difference between the $1,195,000, the implied value, and the $956,000 would represent the non-controlling interest unless a premium was paid. So let's test it out. Let's take $1,195,000, which is the implied value of 100%, minus the $956,000 that they did pay for 80%, and the difference is $239,000. So unless they paid a premium, a control premium, to purchase the stock, it means that the value of the non-controlling interest on the date of this purchase would have been $239,000. And indeed, the problem then tells you that the fair value of the non-controlling interest was $239,000, which means the problem is now confirming that there was no control premium paid. Now, since we only have a couple people here, thanks, Alex, for joining us. What I would do is throw out the following question. If a control premium was paid, would the fair value of the non-controlling interest be greater or lower than $239,000? If a control premium was paid, would the value of the non-controlling interest be greater or lower? This is sort of a little trick question, so be careful how you answer it. And I'm not going to call anybody, so we'll just wait here for volunteers. I got plenty of time. I don't have another conference call till 3:30, so I can just sit here and wait. No, just kidding. So anybody have any idea? It's a sort of trick question, so I know it's putting you on the spot. We got a brave soul out there. Maybe. Again, the question is, what would the non-controlling interest be in value if a controlled premium was paid by the purchasing corporation? Would it be greater or lower than the $239,000? And since we don't have too many brave souls here today, we'll tell you that the controlled premium fair value, as stated in the problem, would still be the same $239,000. If the control premium was paid by the parent, it doesn't change the fair value of the non-controlling interest, particularly in this problem where it's told you that the fair value of the non-controlling interest was $239,000. And the problem is telling you that, which is implying that, yeah, right. Okay. Good. That's great, Connor. You're going to get 10 points for that. You would have gotten 1,000 if you were brave enough, but you still get 10 points. So when the problem tells you what the fair value of the non-controlling interest is, it means that there's a market, and the market's telling us what that value is. Now, we're going to learn today, later on, we're going to learn that had we not known what the non-controlling interest value was, we would have to go with whatever the value of the implied 100% of the company is. We'll see that later, in which case it would be 239. Here's the next question. I know, that's why it was a trick question. I didn't give that as an option. So here's the next question, which won't be so much of a trick question. But if there was a non-controlling interest, would the parent have, if there was a controlled premium paid by the parent company, if there was a controlled premium paid by the company, would the parent company have paid more than $956,000 for 80% or less than $956,000 for 80%? So there's the question now. And Rachel's answering more. And let's see if crowd mentality takes over and everybody answers more, or if someone's going to take a shot at less or the same. Those are the three choices, I suppose. Rachel says more, and Rachel is correct. That's the idea of control premium. The fair value of the company is $1,195,000, and more was paid for a control premium, not in this problem, but if there was a control premium paid by the parent, it would be more than the fair value as traded on the market. Here's more of what you know, by the way. If the problem had just told you that the non-controlling interest fair value is $239,000, and they said, what did if the parent paid $100,000 control premium, what did the parent pay? You would have been able to figure out that for 20% of the company to be worth $239, that's the non-controlling interest share. For 20% of the company to be worth that, you would have been able to figure out that 1,195 is the value of the whole company. You would have been able to figure that out by dividing 239 by 20%. Then the problem says a control premium of 100,000 was paid for the 80%. So you take 80% of the 1,195 to get 956, add 100,000, and you would have figured out that they would have paid $1,056,000. I'm just spouting off math, and I know you're not necessarily following it, but I think you get the picture of what I did, which is basically I can figure out the implied fair value of the company by knowing either one or two of the variables, either the amount actually paid or the non-controlling interest fair value. It all helps me get to the same thing of what the implied value of the company is as a whole in the marketplace. Control premium will make the ultimate price more, but only for the hands of the parent. Only for the hands of the parent. Okay, let's just see what the rest of the problem says. Then it tells us that the fair values of the identified assets and liabilities are the same as the carrying amounts on the books, except for one thing: a plant which has a value more than on the carrying value, excess fair value from what the carrying value is, 100,000 over 20 years. And now you've pretty much set. Yeah, I don't have ability to write that down here, but I will. I can do it in the chat room. You're right. I can do it in the chat. From now on, I'll write them down in the chat room for you. Good point. Here you have a situation where you have $100,000 of excess carrying amount for the fair value of the plant assets. And of course, what we know, what we normally now know, is we could quickly say, okay, we got 100,000. It's going to be depreciated over 20 years. And so we would have an amount of whatever that comes out to. 20 years, it's $5,000 a year. That's how we would figure it out. And that's going to be our depreciation for that particular asset. Now, let's go further. Let's see what the problem actually wants for number 4, January 1. Well, what's January 1? January 1 is the day of purchase. Oh, and by the way, let's do one more thing that we now know. We have enough pieces to figure this out. We know that the implied value based on 956 purchase price divided by 0.8 equals 1. Oops, I'm writing that 19500. That's the implied value of the whole. That we know. We know that the fair value of the non-controlling interest shows us that there's no control premium. Why? Because 195 divided by subtract 239. This is the math that we already did. Shows us that absent a control premium, the fair value of the non-controlling interest would be 239, and that's exactly what the non-controlling interest is told to us. And yes, the $100,000 plant assets is overstated. So now what we want to do is we want to say, okay, let's figure out what we got here. What we got is carrying value of the company is, oh, so let me ask you, it's right on the screen, but what's the net book value of the company? What's the net book value of the company? Exactly, and it tells you that. It says the carrying amount of Shaw's net assets, and what is net assets? How do you define net assets? Well, it's book value. It's assets minus liability equals net assets. Net assets is book value. Very good, Alice. All right, so we have $1 million is the net assets, and the purchase price indicates, as you already see on the screen, the purchase price indicates that the implied value is 1,195,000. And so 1,195,000 minus the carrying value, the book value rather, is what we need to explain, or $195,000. And we know that part of that is the value assigned to the plant assets as being over the carrying amount. So as you can see from this little mathematics, it means that 195 minus 100,000, which is explained by the plant assets, is going to leave us 95,000, which is, and now everybody knows in the classroom, going to be assigned to the famous word, and everybody knows it, goodwill. All right, so now we know the goodwill amount based on this purchase. Let's see what the problem is asking. The first, number 4, is asking on the date of purchase, which is January 1, how much goodwill will be reported? And there you go. We have already calculated it out as $95,000, and that is the correct answer, 95. All right, so far so good. We're going to come back to this problem later on, so we'll keep in mind the concepts that we've learned so far, and we'll do number 5, the next one on here, at a later point. Okay, so now back to something or other. Let's see what we got next. What we got next is we'll go back to the chapter PowerPoint. Incidentally, what I'm doing is I am not putting my picture on the video because I think that slows up the internet connection, and plus I got a buzz cut over the weekend. So if you stay to the end, I'll show it to you, but only at the end. Okay. All right, here we go. All right, hopefully hearing me now. Okay, that's the net interconnect connection. Okay, nothing too quickly. Let's go see what we got. Let's now look back to chapter 4 of the PowerPoint. Let's just go quickly through a couple of the slides so that we can get an idea of what's going on. Hopefully you can see what I'm seeing, which here we go. Let's say we got a total acquisition fair value paid of 690. The fair value of the identified assets is 600. They paid 10,000 shares to buy it. It's $60 a share. Oh, they're telling us not that they paid 10,000 shares. They're telling us that they spent 690 for the fair value of the company, and the company is worth $600,000. How do you know that? The shares are trading at $60 a share. So the difference is going to be allocated to goodwill because they're paying, obviously, they're paying above the fair value of the stock. Now, what they bought was they bought 90% of the company. How do we know that? That's on the previous slide, or it was in the previous, should have been part of the facts, maybe it was in the textbook. And now we're going to see how this all works out. So what we're going to see is if the company total acquisition fair value is 690. Pardon me, I'm just trying to get the facts straight because I flipped to this page. I just want to see where we're at. Okay, so let's go to the next page and it'll help fill in the blanks. Oh, okay, so here's the fair value acquisition price was 630. What percentage are they buying? They're buying 90%. All right, now we can go back. Now I got it straight. All right, thanks for bearing with me. Okay, so the purchase price is going to be 630,000 for 90%. 630. That's not even right. They paid 540 for 90%. Where am I getting the 630? All right, I got my facts mixed up here. Let's go. Let's see what they got here. Fair value at acquisition date, 630. Fair value at net of. That's one of the problems with this particular slide is they don't give me all the facts that I'm looking for. Let's see. Yeah, they paid 690. Okay. Does that make sense? 690. No, they paid 630. I'm sorry. My apologies. It doesn't flow with the information that they're giving us here. Let me just find out why. Timeout on the set. I looked at the this. I didn't look at this slide beforehand because I thought we were going to start a few slides ahead, but the system's not allowing me to go ahead at the moment. So we're just going to have to stay with what we got. Here it is. Okay. All right. We did this last time. All right. Here we go. Let's pretend the last 3 minutes didn't occur and we'll start all over. Parker purchased 9,000 shares at $70 per share. The fair value of their consideration transfer is $630,000 because that's 9,000 shares at $70 per share. It's amazing when you can roll back time by 3 minutes and start all over. So now we know they paid $630,000 in value using their shares. So that's what they paid for. And they're buying 90% of the company. So let's do the math. Let's first do the math ourselves. They're paying the equivalent of 630 for 90%. So what does that tell us about the fair value of the company? It tells us that the fair value of the company as a whole is $700,000. But we're told that, guess what? It's not 700. Yes, based on the fair value price here, I think we can do something interesting. So bear with me a second. Based on the fair value of 630,000 paid for 90%, if you divide that by 90%, you're going to get a fair value of $700,000. Okay, fair enough. 630 divided by 0.9. But it turns out that the company is not worth $700,000 based on the marketplace, because the marketplace tells us that the fair value of the non-controlling interest is 60. If the full company was really worth $700,000, the non-controlling interest would have been worth 70,000. I think you get the idea. How come I lost you? Did I lose you again? Hopefully not. Are we there? I think we're there. Okay. So the fair value would have been 70,000 for the non-controlling interest in order to get to a full fair value of the whole company at 700. But it turns out the non-controlling interest is 60. That means, therefore, that in essence, what? That means what? That there's been a payment for an amount greater than the actual share price on the day of the purchase. What's the share price on the day of the purchase? Well, if 1,000 shares of the remaining 1,000 shares not purchased, meaning the other 10%, is trading at $60 per share, it means then that for 10,000 shares at $60 per share, the full value of the company would be $600,000, not $700,000. The full implied value would be 600. So we've got a disconnect of $100,000 in the implied fair value for the whole company. This certainly means that a control premium has been paid by the purchaser, and the slide is showing you that the control premium the control premium paid by the purchaser is $70. It's telling us that. We could have figured that out on our own because we knew they bought 9,000 shares for 630, so we could have figured it out that $70 a share. But now you see that the math is going to work out. The implied value is, I'm going to change this marker this way, make it a little bit easier. The implied value is 700K. The actual market value tells it's 600K. That equals a difference of $100,000. And if you take the fact that the difference between the purchase price is $70 per share, but the market price is $60 per share, so if you take that information, a $10 per share difference for what is really 10,000 shares will tell you that that's going to be worth 700. I'm sorry, that's a $100,000 difference. That ties into our difference. So now we know that the implied value at 700 is explained by the fact that the fair value in the marketplace is 600 by a $100,000 difference in the implied value. However, the company only bought 90%. So if the company only bought 90%, they only paid how much of this control premium amount? They only paid 90% of the control premium amount. The control premium amount is implied at 100, but they only bought 90%, so they really only paid for 90K of the control premium over and above the market value. Of course, all control premium goes to, like everything else we're saying, when you have a difference like this, all this goes to goodwill, which we'll see. All right, now the math is going to start making more sense when we get here. Strong bought it for an acquisition fair value at the fair value, the actual fair value when they bought it was 690. That's the actual fair value of the identified assets acquired at 600, and the difference is allocated to goodwill. How do we know they paid? How do we know it's to 690? Well, let's see the math on the next screen. They paid 630 for 90%. The relative value of the company is trading at $600,000, and 90% of 600, see here, 90% of 600 is 540. That's the identified asset value based on the marketplace. Sorry for this messed up circle there. So since 600,000 represents the full value of the company based on the marketplace, 90% of that would have been 540. So how much did they actually pay over the marketplace value, which is the control premium? The difference between what they paid, 630, 540, $90,000. So that's another way to show how much the control premium was. It's just doing the math a different way, and it all goes to goodwill, as you see on the screen. So hopefully this is all making sense now that I got the flow of the PowerPoints rolling along here today. So once again, what did we do? We said that the trading value of the stock is $60 per share, which shows us a real value of 600,000, but the implied value for the whole would be 700. That leaves a difference of 100, but they only bought 90%. That means the control premium that they paid would have been 90K. That's the goodwill for the control premium. Here's another way of looking at it, which winds up with the same thing. Fair value acquisition date was 630. That's what they paid. 90% of the real value based on the marketplace is 540. Difference $90,000. Notice that the non-controlling interest trades at exactly what the marketplace is. It doesn't have a control premium. Nobody's paying control premium for it, so it remains at the amount on the marketplace at 60, and there's no goodwill allocated to the non-controlling interest for the control premium. And that makes sense. Why should the non-controlling interest have a control premium? They're not paying. They're just having their value based on the marketplace. Now, this is a new example, same facts, but new example with one slight change in facts. What if we didn't know what the non-controlling interest value was on the marketplace? That's what this is about. What if we didn't know what the non-controlling interest value is on the marketplace? All we could do is use the implied value based on the purchase, and that would mean that we're looking at a 700K value, and we'd have to assume that that's the value of the company as a whole, because we don't know what the marketplace is telling us the non-controlling interest amount is. We'd have to assume the whole value of the company is 700. Only 90% is bought, which would mean that the remaining amount goes to the non-controlling interest. That's all we could do. All right, so we've covered a lot of ground here in the understanding of control premiums when a company is bought, and what it means in terms of how much more money might actually go to goodwill. Remember, there could be more goodwill within the actual price paid. This is the control premium that we've been talking about that gets allocated to goodwill. How could there be more goodwill? Because even in the amount paid, meaning the 630, it could have been that we can't identify all the difference in this amount compared to the fair value of all the identified assets. We may still have residual goodwill even in this number, which means even in the actual fair value of the assets here on the marketplace, could have been that there was some goodwill in there as well. In this case, there isn't, but it could have been that there was goodwill inside the fair value on the marketplace. If there was, notwithstanding control premiums, which is what we're seeing in this problem, always gets allocated to goodwill. Okay. There we go. Is that the same? That's the same. Oh, so this is the case where what if we could only do this? What if we could only say we don't know the value of the non-controlling interest because there's no marketplace for it? What would be the value of the company? Based on the purchase price is all we would know. We would allocate $700,000 to the total company as its value because we don't know what the marketplace is for the non-controlling interest, and thus the result would be you would come up with goodwill like this. You would come up with the fair value for the controlling interest is 630. Now you would have to assume that the whole company is worth 700. So you put the other 70 to the non-controlling interest because you don't have a market value for it. And so now you would come away with Well, we know we would be told what the value of the identified assets are. That we're going to wind up knowing through the due diligence that will be done by the purchaser. So we'll have that. We'll know the fair value of the identified assets is 600. So when we come down here and we say, all right, so 10% of 600 is 60. See that? But this is what is the fair value seems to be, but we can't explain the difference of 10,000 that goes to goodwill. Notice that the 90,000 goodwill for the controlling interest portion stays the same in this case, which only makes sense because they're the ones that paid, whether they paid it as a control premium or not, they're the ones that are setting the marketplace at 630. All right, any questions so far? We might be overkilling a little bit the explanation, but I think it's good. So any questions I'll like to hear? We'll hold for a second. Okay, I'm not seeing anything come up, but if you have questions, you can certainly email them to me or stay after a little bit. Let's move forward. All right, now what we've been doing is really concentrating on the purchase date and how to allocate a control premium or any goodwill that gets implied from the date of purchase based on where you have a non-controlling interest. We've been really concentrating on the acquisition date, and now we're going to start moving forward, which is the remainder of Chapter 4, which is, okay, after you bought it, now what does that mean? How about the income? Now we're going to show everything at 100%. That's the whole concept of consolidation. Everything's going to be shown at 100%. All right, that's fine. However, we don't own 100%. We only own 90%. So 90% will be the only amount that will be recorded on the parent's books under the equity method. But if we're going to show 100% on the consolidation, it means that there's 10% net income from the sub that's going to show up. Let me just change one spelling. In other words, the first sentence is saying we're going to consolidate 100%, but that doesn't compute. It should be a non-equal sign there. I can't do that, so we'll just try that. There we go. That's what it looks like. It doesn't equal 90% equity method on the parent's books. All is going to be picked up as income, but 100% net income from the sub is going to be recognized on the consolidated statement, and that means 10% of the net income from the sub, it has to go to, or has to be recognized as being part of, what do you think, class? Give me a little bit of a hint. N, C, double A. No, not double A. NC, I. So the net income, there's going to be an amount of income that's going to belong not to the parent because the parent only owns 90%. 10% is going to belong to the NCI, non-controlling interest. Okay, so that's where we're headed here. Let's see how the textbook approaches it. The slide says allocating subsidiaries net income. All right, way to go. Subsidiaries net income, including excess acquisition date fair value amortizations, that means depreciation as well, must be allocated to the parent and the non-controlling interest to properly measure the respective equity in the consolidated entity. Notice the word equity there. That's the concept of the equity method in a sense, but it's to recognize the change in percentages of the equity between both the parent, which is going to record it on their books, under the equity method at the amount they own, and the non-controlling interest will take up the difference. So here, assume that the relative ownership percentage of the parent non-controlling interest represent an appropriate basis. This is telling us we're going to assume, we will assume, when we do consolidations, we will assume that the relative ownership percentages between the parent and the NCI interests represent an appropriate basis for attributing all elements, including that depreciation, meaning the excess acquisition date fair value amortization for identifiable assets and liabilities of the subsidiary's income across both the parent ownership percentage and the non-controlling interest percentage. Final paragraph, including the excess fair value amortizations, is based on the assumption that the NCI represents equity in the subsidiary's net assets as remeasured on the acquisition date. After all, we know what the new value is on the acquisition date because we have a fair third-party transaction. So let's see what this means. Here's what it really means. If the subsidiary earns, it should say $280,000. Oh no, it's right. It's got the rate. It should say 80,000. Look here. Here's the revenue in total. Here's the expenses. Here's the net income. This is the subsidiary. This is the subsidiary in total. So right now we're looking at the subsidiary at 100%. It earns $80,000, and there's excess amortization. Where this number came from doesn't matter. Let's just assume it's correct. $30,000 of excess amortization or depreciation or both. So it means that after we take 100% of the net income and subtract 100% of the amortization depreciation for the difference between fair value and book value of the assets upon acquisition, we get a $50,000 amount of net income for the company. 10% of it gets allocated to the non-controlling interest. It seems simple, and it is that simple. It basically is that simple. 10% gets allocated to the non-controlling interest, and the remaining 90% is going to be recognized as part of the controlling interest share of the income. Now, if the equity method is being used by the parent, where is that $45,000 going to be recognized? Who's going to recognize the $45,000 in their income, on their statement, on their books, if the equity method is being used? And the answer is, anybody know? Anybody there? The equity method, nobody's there. I lost everybody. Well, at least I'm still recording. All right. Nobody's there? Is that for sure? Amar's there. Why? Because, oh, okay. Are you awake? All right. So where's the $45,000 going to get recognized? We're showing 5,000 is going to belong to the non-controlling interest, who already recognized on their books $45,000. Having trouble with this pencil. Ah, beautiful. Wasn't that wonderful? Let's skip that. I think I can do this better. Ah, there we go. So, all right. So you don't want to take the chance. All right. So under the equity method, the parent is going to say, I know what. We're going to see the $50,000 is the net income after adjustments for the amortization, and we're going to take that amount, 45,000, and do a journal entry in our books, and the journal entry will look like this. This is a journal entry that goes all the way back to chapter 1. The journal entry would be debit to investment for 45, and then we'll say credit to equity income. You're familiar with that. And that's what the parent's doing on their books. It's exactly what the parent's doing on their books, and that's fine. That's exactly what we expect. But that means that where in the past we've been used to seeing that the parent in 100% ownership is recording all the income from the subsidiary in the equity method. Here they're only going to be reporting 45,000. All right, before we move forward, we want to do the big picture. That's what we want to do. Here's the big picture. The big picture is that the non-controlling interest actually concerns us in 4 ways when it comes to the consolidation process. Let's see what they are. We want to know what the subsidiary's non-controlling interest is at the beginning of the year. In the cases that we've seen thus far, it would be at the date of acquisition. But if we're looking at a case beyond the first year purchase, it would be what's the non-controlling interest share at the beginning of the year of consolidation, much like the retained earnings of the subsidiary. We want to know what the non-controlling interest is at the beginning of the year. We want to know what the non-controlling interest share of net income is. That's number 2. We want to know what the non-controlling interest share of dividends are. That's number 3. And we want to know the non-controlling interest at the end of the year. This will all make more sense when we actually do the work. But for now, keep in mind that we're going to have 4 areas of interest when it comes to the NCI. And that is beginning, end, income, dividends. Just what you would expect since we're tracking the equity, which is really what the non-controlling interest is. The non-controlling interest really is the equity belonging to the non-controlling interest. I'm going to say one more theory part, which is if we were showing at date of acquisition, that in order to make the balance sheet balance, we put the difference to the non-controlling interest. So that is the beginning amount of the year, or at least for date of acquisition, that's the beginning amount here. Then to follow the changes going forth this year and future years, we want to see how much net income belongs to the non-controlling interest, because it doesn't go on the equity investment method on the parent's books. They don't record it. So it goes to the non-controlling interest. We want to record the dividends paid to the non-controlling interest shareholders as a reduction of their equity, and we'll get the year-end balance, which will be a computation. All right, so here we get some new facts. Assume that King Company acquires 80% of Pawn's Company, and they have 100,000 outstanding shares, January 1, 2014. What a great year. $9.75 per share, or a total of 780,000 cash. That's what they pay for it. So let's see what the full value of the company is. If they paid $780,000 for 80%, that means that the full value of the company should be $975,000. Let's see if it makes sense. Well, on the marketplace, it's trading for $975, 100,000 shares. That means the value of the company is $975, and there you see it right there. And it means that the non-controlling interest amount is exactly $195. And now I want everyone, we got 4 people here. It's an unbelievable crowd. Can't handle it. We want everyone here to tell me, was a control premium paid? And I'll give you only 2 letters to use in answering the question. You can only use 2 letters. So was a control premium paid? And let's see if everybody can get it right. Only 2 letters. That's unbelievable. You all got it right. Really good. All right. And that's right. And why? Because the total value of the company is trading at exactly $975,000 for the total value. For 80%, they paid 80% of the total value of the trading value of the company. So there was no control premium paid. If they paid more than $9.75 per share, then they would have been paying a control premium. But they went to the marketplace and nobody held out for more. Okay, excellent. Ooh, you knew it was too good to be true, right? Okay, so let's see what we got here. All right, we got an explanation. One more second, let's try one more thing. Okay, I think that's as good as it gets. What they're doing here, even though it looks like ugly, but it's not, it's really the same thing we've been doing all along. It's taking the full value of the company, which is 975, and it's figuring out how to allocate that based on the identified fair value of the assets. Let me say that again, is taking the 975 and figuring out how much is that over the book value. That's here. It's over the book value by 235. Okay, so what's the fair value of the assets compared to the book value? Well, this tells you the pluses and the minuses. We've been doing this over and over again, and it leaves 25,000 unexplained. Residual value method, that's the goodwill. Now that's the goodwill based on the total 100% value of the company based on the marketplace shares and the implied value of what was of the value paid by the parent, which was again $9.75 per share or 975,000. That's the goodwill based on 100% of the company. How much of that goodwill belongs to the parent and how much of it belongs to the non-controlling interest? Remember, recalling that this is an 80% purchase. So I'll leave for everybody to see if you can put in the goodwill percentage to the parent. How much would that be? And the goodwill that's going to get allocated to the non-controlling interest. Total goodwill is 25, and I'll give you a hint on how to do this. Maybe I'll do it by the way the tax code does it, the way the tax code says what things are not. Yeah, well, I can't figure out how to do that. So let's figure out the goodwill that belongs to the parent. 20,000 for the parent based on 80%. That's correct. Go to the head of the participants list, and that means that the amount of goodwill going to the non-controlling interest is going to be, and we're letting there we go, perfect. That's exactly right, and there you see it. I don't know if it showed on your, maybe it showed on your screen. It didn't show on my screen. If it showed on your screen, I'll still give you great credit for it. So this is how it gets calculated. Good. Good. That's great. So now I know what I'm doing from my end, what you can see and can't see. So there you go. That's how the goodwill gets allocated. Does it really make a difference? Well, yes and no. We'll see. But it's good to know that this is how it's working. This tells us that the parent did not, this fact alone, by the way, also tells us that the parent didn't pay a control premium. Because if the parent paid a control premium, the allocation of goodwill would not be a strict 80-20 percentage. That's one of the ways you know if a control premium has been paid, if the goodwill has been allocated not strictly according to percentage owned. All right, let's go back up and see what we got here. All right, now let's continue the example non-controlling interest where there's income. That's what happens. We're going into, ooh boy, we're going into 2 years here. That's good. Yes, you can do that. That's exactly what I would expect you to do. That's right. Good work, Alex. Okay. All right, so this problem was bought on January 1/14, and now the textbook decides that they want to take you not to the end of 1 year, but they want to take you to the end of the second year, 2015. So that is going to be a harder sell than I imagined because we're skipping through 1 year of equity method and consolidation. We're skipping right to a second year. And that's a leap. We did that in chapter 3. But before we do that, let's just take a look at what the financial statements are supposed to look like when they get consolidated using a non-controlling interest. Here is the income statement. This is what it's going to look like. I like to do this because sometimes it's good to see what's the goal. What are we after? Oh, so that's what we're after. I guess I'm going to have to do a certain calculation in order to find out certain numbers in order to meet the goal of the picture I'm trying to paint. So this is the picture I'm trying to paint, which is the consolidation for the year ended December 31, 2015. I'm going to show the revenue of both companies put together. I'm going to show the cost of goods sold of both companies put together. I'm going to show the depreciation expense on both companies' books plus or minus the differential in depreciation based on the excess assets at acquisition date, whatever that was, plus or and the same thing with amortization. It'll be the amortization recorded on the books of both companies, plus or minus the excess or not excess to amortization based on the amortization, based on the acquisition date calculation. We've done this before. So these numbers, this depreciation and amortization, could be adjusted from what's on the books of the company, but it'll eventually total for both companies plus that difference, and the interest expense for both companies put together, and any interest expense modification based on consolidation, which there might be some, and we'll get a consolidated net income for everything. See that? This is everything, 100% of everything. Recalling that the ownership percentage is only 80% by the parent, but this is on the consolidation 100%. We show 100% on the consolidation, so we've got a consolidated net income representing 100% of the consolidated total. But of this amount, the $416,000 that's shown here, of that, not all of it is attributable to the parent, because the parent only owns 80%, and the rest of it is attributable to the non-controlling interest. So what the consolidated net income statement wants to do is it wants to differentiate between the two. The actual consolidated net income is $416,000. Make no mistake about that. That is true. But it doesn't mean that we can't show in this body of the statement the breakdown of the 416,000 between the parent amount of income of the 416 and the non-controlling interest amount, which is the 20% that belongs to the non-controlling interest. Notice that's not 20% of 416,000, because included in the 416,000 is what? Included in the 416,000 is included the income and the expenses of the Who. Of the Who. Of the Who. That used to be a rock band. Do they still exist? I doubt it. Included in the 416,000 is the income earned by the parent company and the income earned by the subsidiary company as modified for the excess depreciation and amortization. So the amount that belongs to the non-controlling interest is not simply 20% of the 416, because it's only 20% of the amount that belongs to the subsidiary. And that's why it's not just 20% there. What this is telling you, what the goal is now the consolidated statement is telling you that if you looked at the parent by itself, including the equity method amount of income from the subsidiary, it would have had a $400,000 net income. So let me say that again, because it's kind of really important to see what the goal of the picture we're trying to paint. The consolidated net income statement is going to show you the total amount of income earned by all companies at 100%. And then it's going to break down saying, well, of that, the subsidiary's non-controlling interest shareholders, they really earned $16,000 in this case, and $400,000 would have been what the parent shareholders would have seen had they seen a statement of the parent just using the equity method for their percentage ownership of the subsidiary. So it would have included 100% of the parents. This is really important. This number, the 400,000, would have included 100% of the parents' net income, and then 80% of sub. That's what the 400,000 would have been under using the equity method, of course, for that 80%. So hopefully you're following the goal. That's real important. You can just try to follow the goal. And then the statement of changes in the owner's equity is very simple. It's merely breaking down the retained earnings of the parent company over here and showing the change based on the calculations we've already made, which shows the $400,000 of net income that we described above. So this number here really just goes down to here. The amount of dividends that the parent paid to its shareholders is shown there. And then the non-controlling interest You'll have a beginning amount, and then we'll show its income, its share of income. Get another color in there. Its share of net income is 16,000. That's a great circle. Will be added to the beginning amount, and the dividends that were the 20% of the dividends paid, this is 20% of the dividends paid by the non-controlling interest will go against the paid by the entire subsidiary. 20% of the dividends paid by the subsidiary will get allocated to the non-controlling interest to get a ending non-controlling interest. So if I ask you the question, and this is how multiple choice questions work, they'll show you this statement of changes in owner equity, and they'll say, well, how much were the total dividends paid by the subsidiary in this year? Knowing that it's an 80%, 20% relationship. They'll ask you how much was the total dividends, and let's see if you can figure that out. Anybody want to try to take a guess? I'll tell you what, I'll give you another hint. It's, well, wait, let's see. Alex might be taking a stab at it. $48,000. Okay, that's interesting. How did you do that? If 10,000 represents 20% of the dividends paid out, because that's the non-controlling interest, then the total amount of dividends paid by the subsidiary would have been, all right, now I'm going to give you guys a hint. The hint goes like this. It's in the tens of thousands. It's between, let's see, the number is between 40 and 60. It's a number that's in the middle of between 40 and 60. Very good. Yeah, I think you got it before I even gave the hint. So the way you do it is you say 10,000 was paid out as dividends. That represents 20% because that's the non-controlling interest, and that would get you 50,000. So you're doing a lot of implications through that kind of little simple algebra in all these problems where you have non-controlling interest. Where did the $40,000 get recognized? Since we're only showing 10,000 against the non-controlling interest, where did the other $40,000 go? Think to the equity method. What do we do with dividends paid on the parents' books on the equity method? Dividends paid to parent under equity method do what? They reduce the investment. That's where the other 40,000 is buried, so to speak, in the reduction of the investment. And through the consolidation process, it gets wiped out entirely because it's all part of the same company. Dividends paid intercompany are really all part of the same company. The only dividends that show are the dividends that are showing to outsiders, $10,000. That's an important point. So let's spend another minute on that. Just so you can see this, let's make a little space. The only dividends that we want to show as being paid to outsiders are the dividends that are paid to shareholders outside of the consolidated whole. The consolidated whole is the parent and their shareholders. They're shareholders. Yeah, there's some kind of hidden meaning with that, I think. All right, and then and they only own 80% of the company. So it means 20% of the dividends paid out do show as going to the non-controlling interest. So that's a big difference from what we did in chapter 3. Because they do show as because they went to the non-controlling interest shareholders. So if the dividends paid by the sub to the parent was 50,000, I'm sorry, if the dividends paid by the sub was 50,000, 40,000 went to the parent. We don't show that because that's intercompany. But the 10,000 that went to outside shareholders of the consolidation, which is these guys right here, the non-controlling interest, that will show on the statement. That's another good reason to take a look at that so that we understand the goal is to show the amount of dividends paid out to the non-controlling interest shareholders. All right, one more part of the big picture is the following. This is what the balance sheet will look like. Of course, the balance sheet will not show the investment because it's consolidated. It will show the goodwill. Notice the goodwill is the full amount of the goodwill. We don't break out the goodwill between controlling interest and non-controlling interest. These are assets at 100% in the controlling balance sheet. And we do show in the net equity, we do show the amount of net equity that belongs to the non-controlling interest, and we show the retained earnings belonging to the parent. These numbers came right from the previous slide. There's the 213, the non-controlling interest amount. That shows on this slide as well. So that's the big picture of what we're trying to show. All right, so how do you do all this? Very simply, sign up for this course next fall, and then it'll make more sense. Now, let's see if we can make sense of it now. You need to take a breather. A lot to this. It's really chapter 4 with one change, and that's this to show the non-controlling interest. Again, not so simple, easier said than done, but that's what it's all about. What I want to show you now is this one. This is what I want to show you. Is this the one I want to show you? No, that's not it. We were here. All right, now we're here. Here we go. All right, so if I know what they're doing now. What they're doing now is they went from the acquisition of January 1, 14 to the end of 2015. They skipped a year, and they want you to compute what the equity interest for non-controlling interest would look like, what the NCI would look like at the beginning of the year. In other words, what they're really asking you to do is to do the following. Okay, here's your balance sheet for both companies at the end of 15. But the acquisition occurred 1/1/14. So there's a consolidated year in between here, and that would have been for 12/31/14. So now they're saying, okay, well, so where is that? What did it look like at the end of 14? Meaning, how did it look here in the balance sheet? How much belonged to the non-controlling interest at 12/31/14? Same thing down here. What were their numbers at the end of 14, so that when we do the consolidated statement for 15, we'll know what we're opening with as the beginning non-controlling interest. Remember, that's another part of the equation. We need to know what the beginning non-controlling interest is when we do the consolidation. So you're going to say, now you need to work backwards. We know what it is here, or we know what we're ending up with in the retained earnings of the subsidiary company. We still figured non-controlling interest at the end of 15 yet. We haven't figured that yet, but we're going to need to know what the beginning amount was. So what this slide does here is help us figure out what the opening non-controlling interest would have been. And I'm just going to take a little break. I mean, not a long break, but just a slight breather. And then we're going to wrap this up in like one little fell swoop. Okay. Just want to get where all the facts come from. So what they're telling you here are some facts, which I don't think the slides do a good job of showing us completely. That's what I'm looking for. So we're going to We're just going to have to go with some belief here. It's going to be like a little religion for a few minutes, which is okay. We can work with a little religion for today. Okay, so what they're telling you is the following. That at the end of, so bear with me a second, they're going to tell you this. The subsidiary, which is in the right-hand column over here, has retained earnings at the end of 15 of $620,000. They're going to tell you that this number, they're not telling you, they're assuming you know that this number here means the following. This is where you need some really strong intermediate accounting. This number here is the result of changes in retained earnings on the subsidiary's books for 2 years in a row. Those 2 years would be 2015 and 2014. That's what that number represents. But only on the books of the subsidiary, so it means it doesn't have included in it the excess amortization or depreciation. None of that. It includes the earnings by the subsidiary, includes the dividends taken out. It's what you do with retained earnings on the books of any company. That's what the 620 represents. Then they're going to tell you that the income in 15 was 90. How do they know that? They're just telling you. You could actually probably figure it out from here. Let's see. Yeah, here's the income. The income in the 15 year was 90, and the dividends paid out on the subs books was 50. So now you can go back and figure out what the beginning retained earnings were on the books of the subsidiary, so you would know what the ending 12/31 number would be. And that's what they're doing. So that's the first step. Income in 15 was 90, dividends was 50. The difference in 15 was a $40,000 increase in retained earnings, and thus the retained earnings at the beginning of the year would have been another number, which let's figure what out that would have been. I see part of the problem is, again, these slides don't put everything together, but we can now figure out what the beginning retained earnings were, or the ending retained earnings, 12/31/14. We can figure that out as being, if 620 was the number on the books at the end of 15, minus an increase of 40, so it would be 580. That would have been the ending retained earnings on the books of the subsidiary. Okay, so far so good. What we're going to do is we're going to pause here, not pause, we're going to stop here. I'm going to put together a subsidiary video, speaking of subsidiaries. And in that subsidiary video, I will go through what we need to do with all this information, because the slides are missing some information that are crucial to the textbook problem. So we're going to fill that in for you, and we'll see you there. All right, that's it for a wrap for today's class, which I hope will. Oh, actually, before we wrap it up, let's just go back and finish that one homework assignment, which I think we can now do. In case you didn't finish it before, let's take a look at this, and we're almost finished. So this problem we had before, and the second part of the problem, first part was asking about the date of acquisition, which we already answered, but then the second was saying what should the amount of the non-controlling interest be at the end of the 2008 year, the first year of, and let's see how we would figure that out. This is a good one to finish up with. On December 31, the consolidated amount of non-controlling interest should be what? So what was the beginning non-controlling interest amount? The problem, I'll go back and help you. The problem tells you that it was $239,000. How do we know? Because it says this is the value of the non-controlling interest right there. So that was our value. Now, let's figure out how much income went to the non-controlling interest and how much of the dividends went to the non-controlling interest. That would change the non-controlling interest to the end of the year. Well, we have $5,000 of depreciation being taken for the plant assets. That's one modification to the net income of the subsidiary. The subsidiary had net income of 190. If we reduce that by $5,000, we'll get 185. So let's type that down there. Watch, I'll get the wrong answer. We get 185. The dividends paid out by the subsidiary was 125. Let's come back to that. Let's finish up the income amount. What's the percentage bought? What's the percentage here in this problem? It's 80% to the parent and 20% to the non-controlling interest. So of the 185 net income, how much belonged to the non-controlling interest? Just do the math. 185 represents already modified for the excess depreciation. So take this times 20%, and you will get $37,000. So 37,000 of the net income belongs to the non-controlling interest. Now we got to do the dividends. Same thing with the dividends. 125 was then paid in total. So 125 times 20% equals the amount that belongs to the non-controlling interest, or 125 times 20%, $25,000. And now just do this, the typical math you do for intermediate accounting. If the non-controlling interest starts at 239, it's plus the income, 37, minus the dividends, 25, equals, you guessed it. I have no idea what that comes to. Let's see. That's why I said you guessed it, because I don't know. 37 minus 25, 251. And let's see what happened with the next problem. There it is. There it is. Answer C, which is exactly right. So you see, what do you see? I don't know, but whatever you see, say can you see? That's right. Good deal. All right, look for a subsidiary video, a supplemental video, to make up for the slide presentation, which I apologize for. I always know that some of these slides get from the textbook don't contain all the information, but we will make up for it, and then you're going to be ready to do the next set of homework or problems. I wonder if it's the snow day that's knocking me out here. All right. I'm going to stay on for a few minutes. If you have any questions, please feel free to write them